This is our 2023 individual filing update. It's going to give you sort of an overview as to operations and some of the highlights that we know about or we're finding out about. Um, as time goes along and as the season progresses.
Before we get started, I did want to thank everybody that has signed their engagements for this year and just remind everybody else that hasn't. It is vitally important that you do get that engagement signed and updated. If you're having any issues with it or have questions, please reach out to us, Matt, Tracy. We're here to help you get that done. As we go through this, there's a couple times when we're going to reinforce that so that you, everybody does get engaged. All right.
Okay, having a technical problem. Let's try it again. Maybe it just timed out. It was sitting there for a while, waiting. It was.
Mhm.
All right, we're going to talk a little bit about staff updates, technology and processes. We'll be turning it over to Matt Duben, who's heading up our operations here so that everyone's comfortable with how we are going to be working together this year, discuss filing deadlines, talk a little bit about IRA, Roth, and HSA contributions. There is still time to make these. Talk a little bit about TRAFA, which is the new tax bill that is worked its way through the House, and now it's on the floor of the Senate. So we'll see if it goes into effect in a timely fashion. I'll talk about RMDs and charitable gifts, and there has been an interest rate increase for unpaid tax bills. We just want to make sure everybody's aware of that. And in terms of personnel, we've had a couple of personnel changes. Some of you recall JC, who was our administrator for a period of time. And she has moved on. She found another position. So we have decided not to replace a receptionist position in its essence.
Yes.
What we have done is we've brought in, and many of you have met her, Tracy Harrison, and she is working more along the lines of an operational capacity. And she will be at your disposal and available with questions. She is triaging phone calls. She's triaging a lot of the emails that are going to the Duben CPA.
And she will be, primarily the one sending out your tax returns and communications from that standpoint. So we have replaced, and she is full time. She is here 9 to 5, Monday through Friday. But there isn't a live receptionist or person answering the phone, so you will be required to use the auto attendant. Our directory assistance should be up and functioning. If you dial our direct extensions, if we're available, we'll pick up the phone. If not, please leave a voicemail and we will get back to you.
If for any reason we don't, Tracy is very good at putting a bug in our ear, and we are returning calls based on her emails and her guidance as well. So she is here to help, and we hope you all get to know her.
And we do recommend, if you do leave a voicemail on the general line, please leave a detailed voicemail as to what the issue is so we can get the right person to respond. And we do highly recommend email above voicemails as a preferred way of communication.
All right, so back to individual return information, upcoming filing deadlines. 4/15 is the individual tax deadline. This is again a deadline to pay if you owe without incurring additional penalties and or interest. It is also the deadline to file an extension. If you're not engaged with us as a client, we will not file your extension. So it's very, very important that you are an engaged client well ahead of this 4/15 deadline. And the extension deadline will remain at October 15th as well.
This is re-educating everybody that got used to the extended deadlines last year. We're back to normal this year, so.
So far.
So far, knock on wood, we won't be working through till November.
Wake it up again. There we go. Okay, just a little history lesson here. All right. 2023 IRA, Roth, and HSA contributions. There is still time to do this. You'll have until April 15th to make these contributions. Really would love you to consider Roths for your kids with earned income being W-2 income, or if they have it, 1099 NEC income potentially. This is a great way to get the kids started contributing to their Roth. Most of them likely are below any sort of an income threshold. And parents, you may also, if your child has $2,500 of earned income, they had a second job. They blew through that cash. They don't have that money anymore. If you would like them to contribute to a Roth because they at least earned that $2,500, you can go ahead and make that contribution for them on their behalf.
It's even a great way for like grandparents that are looking for ways to reduce their estate. You can gift it and put it into a Roth account for your grandchildren or children. Even adult children. I have some clients where their parents are getting of an age where they're even giving it to people that are in their 50s, but they have extra money and they're using it as a way to gift it. If you keep that gift below the 17,000, I believe, for this year, you don't have to report anything and you're doing something nice for your children.
And our IRA Roth contribution limits, 6,500 under the age of 50, 7,500 above 50. There's an additional $1,000 catch-up contribution. Again, there are income thresholds for single, head of household, married filing separate. Married filing separate, though, this is assuming that you are not living with your spouse. If you are living with your spouse, that income threshold drops to $10,000 for Roth eligibility in terms of a contribution. Married filing jointly has slightly different thresholds, a little bit larger. Again, we really recommend also the HFAs if you do have a high deductible health insurance plan. These are wonderful saving vehicles. They're treated as adjustments, top line adjustments on the face of the return. And again, it is something that can bring down that tax liability and the money you can also sock away, even for the long term, to use for medical bills down the road.
Yeah, unlike a retirement account, you can use that HSA account anytime you have a medical expense. So
it's a valuable tool. All right, we talked about this a little bit during our business seminar. This is the TRAFA. This is the new bill that is making its way very slowly through Congress. It did pass the House. We are waiting for it to get through the Senate. It's going to make a number of changes, but the ones that would be most pertinent to this conversation would be potentially a 1099 NEC reporting increase. It's been $600 for as long as I can remember. And that would then jump to $1,000 for your 1099 reportable income. And the big one is that it's going to increase the refundable portion of the child tax credit incrementally in $200 increments between retroactive to January 1st, 2023 through 2025. The full amount, I believe, will be to the full $2,000 credit would then be potentially refundable.
correct.
For this year, though, if it passes, that refundable amount will jump a couple of $100s to $1,800. Again, we're really not recommending that you wait. We are recommending let's get the taxes done. Let's see if there's a liability, maybe pay the liability in and then sit on the return until this gets through Congress. We're thinking potentially
The most optimistic is late February. It could go into March. And on a side note, there's really no guarantee it'll get out of the Senate because the Senate's Republican controlled. They may not approve it, but It had bipartisan support through the House, so there's a chance that it could work its way through the Senate as well. But we won't know until late February, early March.
But just something to keep aware of, always changes. Required minimum distributions. Again, these are going to be required for individuals turning 72. This change from 71, 70 and a half to 72 due to the CARES Act that went through last year. And the RMD schedule is just a little bit funky because of, if it's your first RMD for 2024, it would potentially, if you turn 72 and 23, that first RMD wouldn't be then due until before tax time in 2025, the year you turn 73.
Correct. Yeah. Now it's currently 70.
But you can rely on your fiduciary will send you out notices and notifications that you will have an RMD coming up. Very often they'll just ask you to check a box. Do you want it in a lump sum every year? You check that box and you are going to receive that every year. You don't have to think about it. It'll vary depending on the performance of your portfolio and the actuarial tables and all that good stuff. But if you are approaching 72
or 73,
then this is something that should be on your radar. And if it is significant, if this is going to result in kind of really triggering, bumping you into another tax bracket, then one wonderful thing to think about is to consider a qualified charitable donation.
Correct.
David is a big fan of these.
So if you're required now to take your required minimum distribution, you're paying tax. Oftentimes at the later years of your life, you may not have mortgage interest anymore. You may not have a bunch of itemized deductions, but you probably still are contributing to charities. Because of the larger standard deduction right now, you may not get any tax benefit from your charitable donations. One way to fix that or to take advantage of is to have your IRA or your retirement plan make the contribution directly to your charity of choice. What that does is it reduces the amount that you have to take as your RMD, and the money that they pay to the charity is non-taxable to you. So it's sort of a backdoor way of getting a charitable deduction, even if you don't itemize. So I have several clients now that are utilizing this, and it does help. They're able to reduce their R&D requirement, and they reduce their taxable income, and their charities are getting paid. It's key to remember, though, it has to be paid directly by your retirement plan to the charity. You cannot take the money out of your R&D and then make a charitable donation and
from your personal bank account.
Yeah, and have us try to take it after the fact. It doesn't work that way. It literally has to be paid by the IRA.
One thing that's crossing my mind as we are talking about charitable donations, gifts in kind. So items that you've donated over the course of the year to Goodwill, Salvation Army, or larger items. If you wish, we just talked about Smart Vault and how to use Smart Vault. If you've taken pictures of those during the course of last year, if you haven't, great habit to get into this year. Just gather up your whatever you're going to contribute, take a snapshot. You can even, I've got some clients who were uploading all year long, just uploading documents. A great way to kind of keep track of those because they do add up.
They do, and we really should. If you are itemizing deductions, you should keep track of that. So there's a couple things to remember with gifts in kind. One is there's certain limits to it. If you're claiming less than $500 in fair value, there's really not a whole lot of documentation other than you're disclosing to the government you want to claim the deduction. You still have to hold the receipt and have some sort of what you gave, but you don't have to disclose it on your tax return. Between 500 and 5,000, now you do have to report to the IRS who you gave the items to, what items you gave, what was the condition of the items that you gave, what was the dollar value that you're claiming for those items. So it's important for you to keep track of those things. So on top of taking the pictures, ideally you want to sort of keep an inventory list of what you gave and assign that value that you anticipate that they're worth. The other thing to remember is if you bought something for $5,000 and you used it for 10 years and then donated it to the Salvation Army, it's no longer a $10,000 item. You can't claim 10,000. You have to claim the fair market value at the time of the donation. So you should anticipate probably about 20% or less of the original value that you originally paid for it, unless it was kept in pristine condition.
Or appreciated, in which case you may also want to get
Yes.
get items appraised, especially if we are looking to claim, $10,000-$15,000 of contributions, and we will look for an appraisal.
So that is the last bit of information. If you go over the $5,000 limit on any particular category, if you donated $10,000 worth of furniture, you actually need to get a third party appraiser to be able to take that. So anything over $5,000 needs to be appraised, or they're not gonna allow the deduction. That could mean even like clothes. So some people give clothes all year long and they give thousands of dollars worth of clothes. The hard part with that is, in theory, you could give away $6,000 worth of clothes, but if you didn't get it appraised, you can't claim that $6,000. It's very hard to get it appraised if you've already given it away. So if you're thinking that you're going to give away a large amount of items and you want to claim the amount over $5,000, you're probably better to save it all up and do one massive donation and then pay to have somebody do your appraisal for you.
So question, we receive annually, a lot of our clients contribute to the Jewish Council.
Mhm.
So those sheets that they
Won't
provide,
qualify.
that is not a qualified appraisal.
No, I mean, they can put, it does help as far as the under 5,000. I don't see any reason why you can't use that, because
Mhm.
again, it's a very subjective guide. And people often ask me, well, how do I know what it's worth? If you Google like thrift shop values on Salvation Army, Goodwill, there's guides out there that'll roughly tell you a shirt is worth X dollars to X dollars. That's what, like, the Home for the Jewish, when they're doing it, they're sort of saying this is what we're going to sell it for, and
Right.
that's what you're getting your donation for. The reason that it won't work for the 5,000 and above is because it actually has to be an unrelated, a third party independent appraisal. They're the ones receiving it, so it's not independent.
And the likelihood is very strong. The American Cancer Society, and I forget, there's a great organization out there that takes a lot of women's clothes for women who are getting back into the workforce.
Yeah.
They will have most likely appraisers that they can put you in touch with.
Yeah,
And a lot of them, if they know you're going to commit, $6,000 or $7,000 of very gently used clothing,
Will help.
will help.
They'll help.
They'll help.
The other thing to remember, you mentioned appraised or assets that have appreciated. That is another nice way. If you've got a charity that you believe strongly in, and you've got stocks that you've held for 30 years and they've gone from a few dollars a share to hundreds of dollars a share, that is a nice way to get a nice deduction and not pay any capital gains. You can donate appreciated property. You get the fair market value at the time of donation, but you won't have to recognize the gain on the donation. So
There's some opportunities for some savings there. And then again, we want to talk about interest rate increases. Those are going up again. Just like interest rates have been going up all last year. So unpaid balances will be subject to an 8% interest rate, and FTB interest rates are 7%. It's an annual interest rate, but it does compound daily.
It does compound daily. They usually update these on a quarterly basis, but currently those are the interest rates that they're charging. The main reason I wanted to highlight this was, if we went back a year or so ago at this same time, they were about 3%. Now they're 8%. If you don't pay your taxes by April 15th and you owe, and we file an extension till October, and you wait until October to pay the tax that was due, they're going to charge you interest on that difference over that 6-month period. So Before, it may not have been that big of a deal because it was only 3%, but at 8%, it's more than double what it was the prior year. So it's going to be important that you take that into consideration and your opportunity costs. If you're not making 8% on your money in the bank, you're probably better off paying the government than you are sitting on it. The other thing I wanted to highlight is when we give you estimated payments, a lot of clients will opt to hold their money because they would rather have the cash flow than paying the government their money. I don't disagree with that a lot of times. Sometimes the government wants money more than they're entitled to, especially if you have your taxable income goes up and down and you know it's going to be a down year. However, if you do wind up owing income tax the following year and you didn't make your estimated tax payments, they will charge you that interest rate for that estimated payment you didn't make based on that for the time period that it was outstanding. So with those higher interest rates, you may want to reconsider making your estimated tax payments on time. With that, I think we've exhausted this update. Do want to remind everybody to sign their engagements if they haven't. I want to thank everybody that has signed their engagements. We're looking forward to having a great year with you. We are available throughout the year to answer your questions. So please reach out to us, and we'll go through these chats and see if we missed anything. If we didn't get your question answered, we will make sure to reach out to you and get the question answered.
Thank you for joining us. Have a great weekend.
Yes, thank you.